Good afternoon, everyone. Welcome to Project 3810 and our Munch and Learn series. And today I'm super excited to introduce you to our subject matter expert on buying and selling businesses, Mr. Hank Bockus. Come on up. You can tell a little bit more about yourself.
Okay, fantastic. So thank you, Project 3810. So we're going to start just right out of the bat, right out of the chute. Who wants to sell their business? Raise a hand. We got a couple people, maybe. All right, so let's ask this just a little different way. Who wants to sell their business if and when you're ready? Raise your hand. So most everybody raised their hand. So I ask this question most every time that I present to a group like this. And the first time I ask it, yeah, there's just a handful of people. But when you say, if and when you're ready, yeah, most of the people raise their hand. When you think about selling your business, sometimes it's synonymous to think about retirement, right? But there's a book called Built to Sell by John Warlow, and he says that as business owners, you need to have your hand on the ejection ripcord at all time, just to have it ready to where at any given moment, if you had to, you can hit the ejection on your business. You know, so there are reasons that are going to force you to leave your business, and then there are reasons why you can choose to leave your business. So every business owner will eventually exit their business, right? Some are going to be drug out, literally, because they've died in the business, and others are going to choose to do it with purpose. So every business owner is going to exit their business. Some are just going to do it with purpose. Reasons why that you might have to exit, so there's declining sales, there's death of an owner, divorce, relocation. You might have partner disputes. Those are all things that are going to happen that are going to force you to get out of your business. Things like retirement, or you want to use the business capital to go start something new. Those are things that you're going to choose. So we're going to talk about having your hand on the ripcord in order to give yourself a business that's more profitable, more efficient, less risk averse, and therefore you might keep it and run it forever. So most of the business owners that I talk to, you know, this is their exit strategy. Gonna win the lottery. I mean, that guy has a $533 million smile on his face that you just cannot wipe off. But this really is a lot of business owners' plans. And winning and playing the lottery is no plan. You know, when you go to play the lottery, you show up in the store, you buy the ticket, and you just hope. I have heard numerous conversations with business owners where they say, you know, I'm not looking for a business buyer. I'm looking for a sucker with a lot of money that has no common sense and who makes poor decisions. That's what they're looking for. And if that's the game that we play, then go to lottery odds. You've got 1 in 292 million chances of winning. And you and I both probably know people that have a lot of money, right? They didn't get there by making poor business decisions or just being a charity, right? So this isn't a strategy. This is not a strategy. So today I just want to cover the 3 requirements to have a sellable business, what banks are going to look for third-party lending, and then 9 factors really quick that will help you become more valuable as you exit. And then in the end, we'll do questions and just bounce stuff back and forth off. So is that cool? All right, here we go. So any wild idea, just to take a guess, what this percentage might represent as it relates to business transactions. So 7 to 30%, study done by Harvard Business Study. I wouldn't expect anybody to know, but.
For business owners that are preparing?
So right along the line. So what this represents, and it's an arbitrary number, hard to really quantify, but Harvard Business Study did a study that said that only 7 to 30% of privately held businesses actually sell. It's very widespread, yeah. So, and that's why it's so it's kind of an arbitrary number, but it's wide, but it's low. And I think to that point is, what happens? Well, first of all, what happens to the other 70%? All right, so the first thing is it's going to transition to family members, right? Son or daughter works in the business, takes over from father, grandfather, and so on. But, that just doesn't happen as much as you used to. We used to see that, father was a welder, son was a welder, and it's just so on and so on, generational in the business. So that's the first thing. Second thing is it can go to key employees and key management. And third is it just closes. So those are the options, right? 78% of all business owners have no idea what their value of their business is and no exit plan, 0. So what I want to do is just talk about what are the things that you can do now to put your hand and have that ripcord available. Not that you're going to do it, but that you can have it available, and that's just going to make you a better business owner. So I believe that owning a business in the USA is the best and fastest track towards building wealth and financial independence. I mean, hands down. If you look at the numbers, those people that are business owners have that highest trajectory to accomplish that. Now, at the same time, the reason why there are not more business owners is because it is very hard and it's a rough journey, as we all know. So I'd say kudos to you all for being here and what you do, because it's not easy. So who is this guy? Who am I? So I came out of a 4th generation family business, sold the business when the company was 92 years old. I started business brokering in 2018 through that experience. So the smallest transaction I've done is 50,000, the largest is over 12 million. I will sell any kind of business within the state of Oklahoma. And I believe that every business can be sold, but not every business will sell. So that's what I do. I'm an Oklahoma real estate broker. So I'm licensed to sell real estate in Oklahoma and also a member of the National Association of Certified Evaluators and Analysis. So we do a lot of appraisals and estate planning work for business owners. So that's me. So let's talk about the 3 requirements to have a sellable business, all right? So it doesn't matter if you're a manufacturing, restaurant, a tech company, or an insurance, right? So there's point 1, which is complicated formula, right? And as appraisers, we use these formulas, right? You'll hear things like risk rate of return, expected equity premium, weighted average cost of capital. Those are all terms and formulas that we use in doing appraisals. But I use what I call the blue picture method. And this is just a simpler version. And so I have my blue picture, and this is the 3 requirements that are required to sell a business, okay? So this picture represents your business. And sales and cost of goods and expenses go into the picture. And what we want is we want the profit from the business to overflow into this waterfall set of cups, okay? So profit is going to rise up and flow out of the pitcher, okay? So this first of the 3 cups represents that the business profit generated by the business has to produce enough income and cash flow to pay for the principal and interest payment of the debt to purchase the business. That's number 1. Second, it has to produce a living wage for the new owner. Now, a lot of times when I look at business and tax returns and P&Ls, a business owner doesn't pay themselves. So the SBA arbitrarily uses $48,000 here in Oklahoma as a fill-in number. So $48,000 is kind of the standard minimum that the SBA is going to want for a living wage. And then the last green overflow cup is that has to produce a cash-on-cash return based upon the risk ratio of the industry or the company that you're in. All right, so let's think about risk level. So high risk, right? Restaurants are notoriously high risky, right? So the cash-on-cash return that is going to be required for this business to sell is going to be higher, maybe 40 or 50%, as opposed to an insurance agent that has, premiums coming in every month. It's very predictable, and therefore that cash-on-cash return could be less, 15, 20%. So 3 requirements that have to happen. So just as a simple example, so let's just say a business has $100K in profit. This is going to be, we're just going to call this profit. The principal and interest to buy the business payment annually is $80,000. I'm going to say principal and interest. Okay, so this really represents, with SBA terms, about a $550,000 business. So principal and interest on $550,000 at current rate is about $80,000 annual premium, okay? So we're going to subtract. So what's the next one? Yellow. Income. So we're going to use our $49,000 example. Income. Okay, what's the last one? Cash on cash. That's right. So cash on cash, once we subtract these out, so you know, we're already in the hole. Okay, so this example doesn't work. Okay, let's try it again. Just real simple, $100,000 in profit. We're going to reduce the price, in my example here that I've done, is $50,000. Okay, so principal and interest payments has now moved to $50,000. We're still going to use $49,000.
And that's a sale, $50,000 P&I is a sales price of...
So yeah, so this sale price was $550K. So we've now reduced the sale price to, I don't know, $300,000. We'll just, whatever that principal and interest payment, so probably $350K. Great question.
You have the same amount of profit.
Exactly. You still got the same, it's still the same business. The only thing that we have changed is the sale price, because the principal and interest payment to pay back that borrowed money. We still got to do the living wage. Now this is now going to equal to $1,000, which our last bucket is cash on cash return. There's not a lot of cash on cash return. Okay, so a bank is, again, is not going to lend this deal, because they're going to say, you know, there's not enough debt to equity built into the business, all right? So we got to do it again. Let's do it the third time. Same thing. We got $100,000 in net profit. We're going to say it's a $40,000. So again, guessing probably this could be a sale price of $300,000. $49,000 for a living wage. Cash on cash is going to be $11,000. This could work. Hypothetical, this scenario could work. These two could not. So you can go with the formulas. You can go with the complex numbers. But this is just the way that I found to make it the simplest. Any questions about that? So the only thing that changed is the sale price.
More than it is. I get that kind of helps you see pretty quick, but in your experience, has that happened quite a bit? People haven't gone through that process. They want a higher price maybe than what is justified for that?
I don't know if you wrote the slides or not, but great transition. So the exact next point is, so as business owners, the first thing that we do when we don't know the answer is we go to Google, right? So this is, you can't read this, but I'll just tell you what some of these arrows I want. So I just typed in business multiples by industry. And this is the first page that comes up on Google. And there's all these numbers. You can't really read them, but the lowest is 1.03 and the highest is 27.29. All right, as a business owner, I want my business multiplied by 27.29, not 1.03. So the question you ask is, do business owners overvaluate? Yeah, unfortunately, they do. That is going to be the biggest obstacle that you all are going to face in transitioning out of your business, is the overvaluation of your company. So my recommendation is go to reliable sources, go get multiple sources, go to industry trades, go find a reputable source before you just do Google. I mean, I literally have conversations every day about that same thing. And you know, I think you ask the question is like, do you believe everything that you'd read on the internet? Yeah, of course not. So
There's also multiples by revenue versus multiples by profit.
yeah, great. So Vicky said there's the difference. Like, what is it a multiple of? Is it a multiple of sales? Is it a multiple of profit? Is it a multiple of, you know, EBITDA? That's this big term that's used in M&A, earnings before interest, taxes, depreciation, and amortization. What is it a multiple of? So yeah, great question. So here's an overview real quick. U.S. Main Street. Main Street is what you and I do. That's labeled as a business that's doing under $5 million in revenue. Okay, in the US, there are 30.2 million businesses registered in the US. This is kind of amazing. Less than 5% do $1 million plus in revenue. Less than half of 1% do $10 million in revenue. So you've got a ton of what we would like to think of Main Street mom and pop businesses. Okay, in 2018, there were 10,312 businesses that transacted in the privately held world. Goop. 10,312. Okay, this is again, I think this is kind of interesting. I hope you guys find this interesting. So businesses that sell between $500,000 and $1.5 million, that's a lot of money. The likelihood that that buyer is going to be a first-time buyer, never owned a business, is 63%. We found this true with the businesses that we sell. 63% of those transactions are going to be first-time buyers. 28% are going to be serial entrepreneurs, meaning they bought and sold before. And 9% are existing companies. The reason why is because when you're in that range, those companies that want to buy you, they're too small to buy you, and yet the bigger companies, you're just too small to be acquired. So the point is, in here, we have to get realistic on the terms and the buyer. As you do an overvaluation of the company, the next thing that you got to realize when you go to sell your business is you are the only you that has ever existed. There is not going to be another twin to come and buy your business. And I think so often a buyer wants the mirror image of who they are to step in and take over. And that there's only one of you. So you just have to be realistic on who the buyer is and the terms. So that's just an overview. Here's some banking overview. The first and hardest thing that I have to do in helping people sell their business is to find a buyer. The next, equally as hard, is get lending. Third-party lending, AKA a bank to finance. Let me ask you, how many $65,000 plus cars would be on the road if there was no third-party financing? Probably not a whole lot, right? The reason why people buy an expensive car or an expensive home is because the financing is available. So any guesses what the number one red flag is of a bank when they're looking at a business to do an evaluation? Number one red flag that a bank's going to go, not for us. It's real simple. No equity, that was one guess. Go even simpler. Simpler than cash flow. Go to the top of your P&L. Revenue. Declining revenue. So,
What do you mean decline in?
yeah, declining. So you're going to have to submit 3 to 5 years of tax returns and P&Ls. And when those tax returns in 2016, 2016, 2017, 2018, 2019, 20, 21, 22, the declining sales, they're going to just say thanks but no thanks. Okay, so that's the number one red flag in lending. So the bank's going to look at these key ratios: debt to equity, balance sheet strength, how much cash you have, debt service coverage. Those are terms you can just look up, Google. All right, now when you're doing an evaluation, when we do an evaluation, we go off IRS ruling 5960, which says that the basic value of a business that is a negative or a net zero cash flow goes down to the hard assets. So what's a hard asset? Computers, desks, furniture, fixtures, equipment, machinery, inventory, AR. So when you look at these last bit of slides, so there's the SBA, which is going to do 90% of all lending in small businesses. They have discounts. So when you have a net profit zero and you're wanting to sell your business and you have stuff, here's the discounts that they're going to use. And these are painful, right? So they're going to take 10% of your book value of inventory. So you've got $100,000 in inventory. They're going to loan the buyer $10,000. That's it. You got $100,000, they're going to loan $10,000, all right? AR is 80% of AR under 90. So if it's over 90, they're not $0. Yeah, it's bad debt too. 50% of existing equipment. So let's say you've got CNC machines, manufacturing, all this kind of stuff. They're going to take 50% of that. They're going to take 10% of furniture, fixtures, and equipment, computers, those kind of things. So and here's one thing that I saw, and I was shocked to see this happen, and this is hard to believe that there are people that do try to take advantage of other people, but I'm here to tell you that it does happen. So I saw an LOI, so a letter of intent, a person that went to a business owner and said, hey, I'm going to offer you $2 million for your business, which was significantly higher of a valuation than the person thought, right? It's kind of like the lottery. They thought they won the lottery. Well, in the LOI, there's a stipulation in a clause that says pending third-party financing. So if you can't get third-party financing, they're out. So that $2 million valuation, they knew there was no way anybody was going to lend against that. So they were able to get in, learn about customers, learn about all these kind of things, and say, oh gosh, we can't get third-party financing at $2 million, and the process got extended literally like a year. By the end, the owner was just worn out and ended up selling significantly less than probably where they could have a year later. So you just got to be careful.
Sorry,
Go ahead.
Do you think that he was like, as he announced that he was going to want to sell it, do you think he was fully prepared to sell it?
Probably not. No, definitely not.
Or did he take 6 months to work on it? Because you had mentioned that he took significantly less than what he's wanting.
So the initial conversation to where it ended and the deal fell up, where it was done, was 18 months. So that initial conversation, he told me that they first came to him and they started talking, and then a couple months later an LOI came. He wasn't prepared, so he didn't have all of these things that we can talk about, but those are just things you got to be careful of as you think about the exit, have your hand on the ripcord. So if you cannot get financing through these avenues, guess who becomes the bank? The business owner, that's right. So if you can't get it, you're going to be the bank, and you're going to owner finance these deals, okay? So
Do you recommend that?
it's sometimes it's the only option. You got to interview the buyer. You got to know their credit. I don't recommend it if you don't go through the due diligence of understanding who that buyer is. But yeah, it can be a great opportunity. It can be good for tax advantages for the owner, because you're deferring taxes until you acquire the money. So yeah, there's advantages, but just be prepared. So we've already admitted we don't believe everything that we read on the internet. We're also not going to believe everything that we see on TV. So who knows who that guy is? Who's that guy? Scrub Daddy. So Shark Tank versus Main Street. Big difference in what you see on TV in Shark Tank and what happens in Main Street selling the businesses. So the difference being that the Shark Tank buyers are buying on prospecting and speculation. Okay, let me say that again. They're buying on speculation. The definition of speculation is they're an investment involving a high risk of loss undertaken on the small chance of success. All right, any investment VC guy or Shark Tank, they're going to do 100 deals. They know that 90 are going to fail. They're totally cool with that. 8 are going to break even, and 2 are going to be home runs. That's the formula. So this Shark Tank is speculative buying. These are what the Scrub Daddy stats were when he went on the show. He's one of the first ones that really hit it big. So he was looking for $100,000 in equity at 10%. You just divide 100 by 10%. That gives you $1 million valuation. This is where the rub hits and where you talk about overvaluation. He had 100,000 in gross sales at the time, but he's valuing his business at $1 million. That's right. So that's the disconnect, and that's the disconnect that is so hard with business owners, because they see Shark Tank and they say, I do $100,000 in revenue, I am worth $1 million. He ended up getting $200,000 for 20%, which that ended up being a great deal, right? They've done millions in sales. I've actually met him, and I know 2 other people that have gotten deals on Shark Tank. The first one got a deal on TV, but then when the due diligence process went through, they weren't apparently true with their numbers, and so they didn't get funded, so no money was exchanged. Another one here in Oklahoma got Mark Cuban invested. They are going through Chapter 11 bankruptcy. So you just got to understand that this isn't the day-to-day. And again, the biggest difference is the Shark Tank investors are cash buyers, so there's no third-party lending, there's no blue bucket scenario, and their risk tolerance is just so much different than your and I's and the average business owner.
Do you think that them being a cash buyer that they could, maybe take advantage of people, like by showing a lot of money and then the business owner?
I don't know the guys at Shark Tank personally. I don't think their intentions are to take advantage of anybody. I really do think they're in it probably for good. I mean, they're not stupid either. I mean, when they see something, they want to make a good return. But when, there's the golden rule, which the golden rule is he who has the gold makes the rules. When you got cash, you make the rules. And so, it's a great question. So how do you eat an elephant? You eat an elephant one bite at a time. So we're going to go over 9 factors that can help you make your business more successful, make you more efficient, less risk averse, so that you can sell it. When and ever that time arrives, you can have your hand on the ripcord, okay? So we're going to go through these real fast. If you want more information in detail on these, I'll be happy to send it to you. But the first one is obviously financial performance, right? The size of your revenue and your past and expected profits. Man, that drives the conversation. Because business buyers are investors, they're not entrepreneurs necessarily, right? There's a big difference. Entrepreneur, you guys are entrepreneurs. You're creative, you're startup, you dream. Business buyer, it's strictly investment. Give me a return. So business buyer wants to pay you for that future stream of profit. All right, so that's the first one. Second is growth potential. Can that buyer expand to other locations? Have you created a model that they can geographically go to another location? Can they grow horizontally, meaning can they sell more to existing customers? And then can they grow vertically by taking what you call like a strategic buy, where they take the assets of 2 companies, combine them together to make a greater return than the 2 separately. So that's growth potential. The third is concentration factor. It's just a real simple one that I think gets overlooked a lot. So if you want your company to be more value, we look at the concentration of customers, employees, and vendors. So first, the customer. If you have a customer that represents 25% more of your total revenue, you just devalued your company.
Say that again?
If you have a single customer that represents 25% or more of your total revenue, you've devalued your company. I've got a couple businesses that 80% of their total revenue is with one customer. One customer. What happens if you piss off one customer? 80% is gone.
Wow.
Okay, same with employees. So if you have an employee that is a great key employee and they drive 25, 35, 40% of sales to your bottom line, what happens if a new buyer comes in and they don't jive? It could be gone. A vendor, this really got exposed during COVID, right? This wasn't even really an issue pre-COVID. You want anything, you buy it, it's there next day. Supply chain got messed up. You realize that a couple companies had 1 or 2 overseas vendors and they are literally out of business. So those are the first 3. Number 4 is, are you a cash cow or are you capital intensive? So how much cash is a buyer going to have to inject into the company? So the more that they got to put in, the less they're going to be able to pay. So capital intensive, if you have heavy inventory, heavy machinery and equipment that's breaking down, those kind of things will affect the value of your business. Reoccurring revenue, number 5. How can you put in place in your business to get up a reoccurring revenue model. And I think when I think about this in my business, I think, oh gosh, I can't do that, there's nothing. But the three best examples that I love and I reference are car washes, right? Car washes were totally seasonal. When the sun's out or after the snow, you go car wash. But now they've got clubs for car wash. So they've created, so my mom signed up for one, $30 every month, man. She's getting billed on her credit card, and I don't know how often she's going. But they've created that reoccurring revenue. Hair club, or haircut, right? There's now these haircut places that are set up, and you can pay a membership, and you can go however many times you want, reoccurring revenue. So the buyer can see where this money is coming from. All right, the number 6 is moat protection. So Warren Buffett notoriously invests in companies that have a deep and a wide moat protecting the business, meaning that it's hard to get into the type of business. So the barrier to entry to start a business is difficult. That's what he likes. If you think about what happened 2 years ago, you know, when we passed cannabis, every corner, they made it, the barrier to entry so easy that there's retail stores on every corner, right? So that barrier to entry is so easy. You want a moat protection. All right, next one. We're going over these fast. Customer satisfaction. We need to know, on a scale of 0 to 10, how likely are your customers to refer you to their friends and family? And if that number is 8, 9, 10, congratulations. If it's 0, 1, 2, you got something to work on. Ownership, goodwill, super important, super obvious. Does the business go home with you at the end of the day? So, and can the business thrive without you behind the steering wheel? The business has to be successful without you. And the last one is documented systems. Man, documented systems, please, you know, get a handbook, get employee manuals, get job descriptions, get policies on what you do when a new customer is onboarded. You know, have access to financials and P&Ls. Don't rely upon your CPA. Use QuickBooks. Use YouTube to figure out how to use QuickBooks. Please use documented systems so that you know what and where your business is. It's shocking of how many times I meet with really good businesses where the business owner has no idea of the financial picture they're in. At the same time, they think, you know, their expenses are tax deductible and they're not because they're giving a receipt to the bookkeeper and the bookkeeper's coding it for something else. And so, you know, just having an overview of all that's going on in your system is going to help you become more attractive to a buyer. So those are the 9 factors to add value to your company. Every business owner is going to exit, whether you're carried out on a gurney or whether you choose to do it with purpose. Any business can be sold, but not every business will be sold. So make sure that you have, as you think about entrepreneurship, as you think about growing, that's fun. But always just keep in the back of mind where that ripcord is in case you ever have to hit the eject button.
Awesome.
So, thank you for a free gift. Now make sure, there's more. There's more. If you want, my email's down here at the bottom, hank@bockusconsulting.com. I will be happy to send you 16 things to consider before you exit. Or, we didn't even talk about, but some of you guys will be business acquirers. 9 of the biggest mistakes that buyers make. And that's a whole nother subject topic. And then I can send you also the 9 factors in detail that we went over. So that is all of those. And now we can just do questions, just spitball examples, things you've heard. I know a lot of times there's like locker room talk of, oh, I know my buddy, he sold his business for tons of money. You know, be careful what you hear.
Believe everything on Google.
That's right.
I have a question.
Yes, sir.
So, like you had mentioned something about, well, in my industry, household moves.
Okay.
There's a lot of moving owners that talk about selling their businesses.
Okay.
And the main thing that you hear them when they speak about selling their business has nothing to do with how much revenue is coming in. It has to do with like the equipment that they have. Like we have 6 trucks and we have this and, you know, but I never, and the way that you put it, that's like on the 3rd or 4th thing that maybe.
Yeah, so,
talk about.
yeah, great point. So let's talk about companies that have heavy assets in their value, right? So when we do an appraisal, there's basically 3 approaches in the evaluation that we use, big picture, okay? The first is income approach, which is kind of what you saw here. Like, what is the cash flow of the business as a multiple? The second is direct market approach, when we compare similar sized companies and how they've transacted across the country. The third is book value and asset value, right? So there are companies that have high asset values, like trucks. And when you weigh those, and you have to weigh them as an appraiser and say, income is worth 50, asset is worth 50. So then we take those 2 numbers and say, yeah, there is value. Absolutely, there's definitely value in that value. But the question all boils back to this, you know. So if you're going to be the acquirer of those businesses, you have to do this formula as well. So they've got $200,000 in equipment. Can you do 1, 2, and 3 with a $200,000 purchase price? If the answer is yes, then good for you, go get it. If the answer is no and it stops right here, or a lot of times it won't even fill up Pink Cup, pay back principal and interest, it's not worth it. Now, that's not to say that those businesses can't be sold, because when a strategic buyer comes in, they tend to be willing to pay more for those assets because they can immediately roll them in. Yeah, so if you've got 6 trucks running right now, and all of a sudden you're able to pick up 4 more, you've just exponentially grown your revenue, theoretically. So does that answer the question?
Yes, thanks.
Yes, ma'am.
2 questions. What business industry is selling the most?
Okay.
And my second question would be, how do you go about selling a consulting business?
Okay, cool. You know, I need to have that answer of industry. I literally get asked that all the time. What industry? And I need to have a good response. I don't see any particular, so I think there are industries that are having a harder time selling. For instance, I mean, the first one that comes to mind, which is print and media, right? Print. That's a tough business. Hot industry. Look, if it's a good quality business and it is priced right, it will sell, regardless of the industry. There, you know, risk and the risk tolerance is a big question. So restaurants, they tend to sell often, but we all see how quickly they fail. So they transact pretty often. Now, consulting business, so in a consulting business, that's a service-based business, right? So you have no hard assets, probably. It goes back strictly to this. What is your revenue? What is your income? What can you do with it? Who are your customers? Do you have contracts with them? So you talk about reoccurring revenue. That's going to be key for you, or whoever your friend is. You know, getting those contracts in place to where you've got some, like 60% is locked in for a year, and maybe 40 is just that time where you've just created space for you to pick up a few extra people or independent gigs. So consulting it's all about the cash flow of the business. It just boils down to that. Good question. Yes.
Isn't for businesses like service-based businesses like that, like your documented processes are going to be probably your biggest asset.
Documented processes are huge.
Because that way you're handing your business over as a turnkey business. This is the manual of how I was making the money. Because when I'm gone as a consultant, the person that people were paying to see is not there anymore. But if I've got all of my process and everything very, very detailed, that means somebody else who maybe has the same charisma or something can come in, follow these steps, and that's what you're selling.
And sometimes this isn't possible, but as we try to grow the business, you're just pouring cash into the business and you're just keeping it and you're just trying to do what you can, right? If there's any way that ownership goodwill, kind of think about that. If there's any way that you can put somebody in between you and the customer so that there is a touch point, so that when you do leave and the new person comes in, they've already got a relationship. Because if I just do business with me, and I say, hey, I've handed off the keys and I'm no longer here, that's going to be hard. Now with a service-based business, and we didn't talk about this, but you know, a lot of times business owners really do. They just want to hand the keys over and see, I'm in Florida. It might be 6 months, 1 year, 2 years, 3 years to get that transitioned over to where you're there and it's moving. That's the kind of the point of what I want to say, and I think you brought it up and it needs to be addressed, is you never know when that time will be. And just saying that you're turning 65 doesn't mean that's the time to retire. Like, it is going to take multiple years sometimes to do this with a service company. Great question.
What do you see typically as some down payments, I mean, like percentage-wise, like 10%, 20%, or they have to do some negotiating, I'm sure, too, whether they do some owner carry and SBA, or what do you kind of see on those?
So in the SBA, the question is like what kind of financing deals you see. So I always tell a buyer have 20% down. I mean, that's what I tell. So if you're going to have a $1 million business that you want to buy, you got to have $200K in cash. The SBA and certain lenders will lend 90 to potentially 100% of the loan value. Okay, so they will. The 9 biggest mistakes that buyers make is over leveraging. That's one. So don't put yourself in an over leveraged position. You always want to have 20%. You can do 90. I don't recommend any more than that, but you can. And owner carry, as long as this works, you shouldn't have to do owner carry. If that doesn't work, then get ready for owner carry.
And owner carry, you mean by?
You're the bank.
Okay.
Yeah, you, the business owner, are the bank, meaning that they're going to go to the bank and they're going to hand over the documents, and that bank's going to say, you know, let's say you've agreed a purchase price of $500,000, and that bank's going to say, I'll give you $300. So that $200 gap that you've come up with, you now have to go and renegotiate. You either got to say, I need you to carry the $200, the business is now only worth $350, whatever. But the owner carry is a part of selling a business. And here's the thing. I got no problem with owner carry. And in fact, I like it because to me, as a person that wants to sell a business, I want to know that you believe in your business enough that you got the faith that it's going to keep on going. Now, I always get pushback and say, well, I'm going to sell the business and I don't want them screwing it up and I don't want to have to take it back, right? But we talked about the transition. You're not handing the keys over. You're not going away. You need to be available to those buyers and help them transition. You want them to succeed. We want them to go on and make the business go on for 20 more years. So you're not going away as much as you think you will. Thank you. Good question.
Sorry, I had another question. So the thoughts came to me that that a person could build like a service business and build it off from the ground, and then have 18 months to 24 months of numbers and reports and whatnot. Could that individual sell that business within those 2 months or 2 years?
2 years
of numbers?
Sure. So I think your question is, correct me if I'm wrong, just with 18 to 2 years worth of financials, can you sell?
Yes.
As opposed to 3 or 5 or 10 years?
The business doesn't have to be from.
It doesn't have to be. No.
Do you see that often?
It's not a whole lot of what I do. Just most of the businesses, I'm trying to think if there's any. Most of them are at least 10 years old, because that owner has done the hard work and gotten to the point where now it is at least sellable. But it's not impossible. I mean, again, any business can be sold, but not everyone will. So yeah, and ultimately, it's what somebody's willing to pay, right? That's the definition of value. So if there is somebody that is willing to pay for that 2-year-old business, yeah, it absolutely can be sold. Good questions. Good stuff. I love talking about this stuff. What else? Anything else?
I think it's good for, sorry that I'm hogging you up.
You're good, man.
I think it's good for a person like me to, well, all of us, right? But I think it's good for me to, like have a consultant meeting with you. That way you can see where the business is and we can kind of like strategize and plan like,
Right.
okay, well, maybe in 3 years or 2.5 years from now, looking to sell or, you know,
Yeah, so
ready.
so often, and you like don't want to be morbid, but I've met with so many widows, partners where the spouse died, right? And there was no plan. Like they had no plan in place, they had no idea. So we owe it as a responsibility of the business owners to at least get something in play. So as you talk about, yeah, you need to know the value of probably your greatest asset. And what are the plans if something happens? You know, call these 3 people, my lawyer, my CPA, and this broker, or whatever it is, the advisors. But you need to know, because otherwise, you know, you're just hopelessly meandering through. And all of that is happening while you're running and growing your business. You know, you got to work on the business, not just in it. And that's a lot of what this is doing. You know, when I sold my business, I started working on the exit in 2013, sold in 2017.
Yeah, so 3.5, 4 years.
And, you know, it's just researching and studying and trying to figure out these 9 factors that, you know, we could do in order to help us be in a position where, you know, you get multiple offers, because that's the goal. Because, you know, 50% of all business transactions that reach agreed to price fail to close. So you want to have multiple offers and multiple contingencies in case one falls through. And when you do the 9 things, you're going to be attractive to where that will happen. There are very few good businesses that are priced right out on the market. So if you can be that person, then you've got a great likelihood of transferring wealth to multiple generations.
And I'll add to that. I've been in a couple of industries now, but that's one of the things, going through these processes is a really great, just like, even if you're not thinking about selling anytime soon, you know, like litmus test for the health of your business. I mean, if you've
Right.
got a business that is sell ready, then it's a healthy business, whether you're selling it or not.
It's
Right.
still good if you check at the doctor.
Yeah.
Exactly.
The doctor check.
You know, I mean, we are here because it's Entrepreneur Week, right? Growing, helping, achieving. Those are exactly your point. This is just to get that litmus test to see where the business is and are there opportunities, right? Looking for the opportunities.
Ooh, that reminds me of another reason that this is really important is if you are in a partnership.
Oh, yeah. Gosh.
Because these valuations are, like if a partner wants to get bought out, you're gonna use this type of thing to create that exit for a partner. So having annual or every 2-year reviews with your partners before you guys decide to break up
Yeah.
is kind of really important too.
Or other side, entrance for a partner.
Entrance for a
Yeah,
partner.
right.
Same exact process, yeah.
Like this is what the business can offer.
Mm-hmm.
Yeah. Yeah.
Do you find that at all? Do you
Oh my
find
gosh.
any
Yeah,
of that?
partner disputes. I mean, that was one of the reasons mentioned, you know, why you're going to sell partner disputes.
Oh, yeah.
Like that partner dispute is happening behind the scenes, and they're like, I want out. Well, I don't want you out. We don't have the capital to buy you out. Argue, 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 and then it comes to, hey, we got to sell. So partner disputes is huge. You know, talking to an attorney about buy-sell agreements, that is huge. That should be in your arsenal of weapons, absolutely. Great point.
And that's a service that you do as well, is just a business valuation?
Yeah,
kind of
so
thing?
we do the business valuations, appraisals all day, every day. You know, ours are pretty thorough, in depth. It's not going to be a 1-page summary. That's not what we do. We do, you know, full business appraisal. That's the specialty of what we do. You can probably go find somebody that can do a little quick one-page calculation of values out there. Cool, good stuff, good questions.
That's good.
Thank you for listening and for paying attention, and hope it helps. Thank you. Thank you, Vicky.